Welcome back. You're watching The Market on ET Now. Coforge has just delivered their first quarter numbers and we witnessed double-digit revenue growth on a consolidated basis. Of course, a chunk of that growth has also come because of an acquisition. But even on an organic basis, they have delivered, a 7.6% growth in dollar terms, 7.5% in rupee terms, which is really not that bad. However, there has been a bit of a dip in their margins, plus we are seeing higher attrition too. Let's make sense of the numbers with Sudhir Singh, the CEO and Executive Director of Coforge. Sudhir, thank you so much for taking our time and joining us for this very first interview. Let's start off first with the top line. 16% on a consolidated basis. Of course, if we take out the acquisition bit, the growth is still pretty good, just a little under 8%. I would say it's right up there when you compare it to the industry. So, what led to that? And what also led to that fairly strong order book that you've managed to amass?
Thank you. And our growth number year on year is 42%. Organic growth year on year is actually 32+%. The numbers that you talked about, 16%, is the sequential quarter on quarter growth. And organic sequential growth, again, as you noted, has been a very robust 7.6% for us. The growth, this particular growth, the 7.6% dollar denominated sequential growth comes on the back of a 7.1% sequential growth that we had registered in the last quarter. And it continues to be a function of the strategy that we are operating with, the market conditions which are buoyant and continue to stay buoyant. And it's again a reflection of the tech capability stack that the firm has built. There's clear demand for it, and there's clear growth and differentiation that tech stack is driving. Just to reiterate, the growth is 16% quarter on quarter, 42% year on year, and the organic growth is 32% year on year and 7.6% quarter on quarter.
Okay. I'll just keep it on the entire order book bit right now, and then we can talk about margins and labor costs. What verticals, geographies are showing good demand, and also how do you see the order book being executed, reflecting on your top line as well in the quarters to come?
Sure. So the order intake this quarter was $318 million. Last quarter, the number was $201 million. This has been the quarter where our order intake has been the highest in our history as an organization. Our order executable, which is the next 12-month order book, is $560 million for the organic business. All these metrics I'm giving you are minus the acquisition. This is just pure organic metrics right now. So when we look at the order executable book that we have right now, that's about 20.4% higher than where it was at the same point last year. Order intake has come in. The order itself and the market demand construct itself is completely and uniformly broad-based. So there's been very strong uptake from banking, from insurance, from travel, also from manufacturing, retail, healthcare, the newer verticals that we've incubated. It's been broad-based growth, and it's been very significant growth from our point of view.
This kind of a business growth, is it the third wave? Is it attrition or margin pressure which would come in? Because we now understand that there is serious attrition uptick which is there in IT sector.
Our attrition numbers, when you look at them, are just 12.6%. They are possibly the lowest across the industry. And our attrition numbers have historically been the lowest across the industry as well. So at this point in time, if you look at the net headcount addition of the firm, we added about net of attrition, 1,138 employees. Within the last quarter itself, our global headcount has gone up by 9.2%. And one reason for that net headcount addition, which has been this robust, has been the fact that at 12.6% for the firm, at least for Coforge, our attrition continues to be one of the lowest, if not the lowest across the industry. That's how we're experiencing attrition at this point in time.
Once this entire work at home model changes, some companies are telling us that they will follow hybrid, on-site engagements will also start. Could that have an impact on SG&A cost? Because that in a sense was a big tailwind for IT sector because of COVID.
I can tell you the way we are seeing it, at least, once the pandemic ebbs, and I hope it's going to be soon, we all hope it's going to be soon, we will move back primarily to a work from office pivot. We will, of course, figure out ways of offering flex facilities and a parallel and alternate work from anywhere model to our employees as well. We don't expect a G&A increase as a consequence of moving employees back to work to be something that is going to drive down margins materially. Last quarter itself, we had said that this year, given the very strong operating leverage that we are deriving from the growth that's been coming in for many quarters now, given the very sharp rebound in some of our key verticals, we expect our margins for the year to go up by 100 bips to 19% EBITDA pre-RSU. And that's something that we believe we will deliver this year as well.
Okay, Sudhir, good luck to you for the future quarters ahead. Good having you on the show.
Thank you very much.